want to learn how to social distance between people, let somebody borrow money. You won't see them again, right? So the idea is, you just don't get paid back. But you guys know how that went. The idea behind this is, if you say you let someone borrow $20, was it just a simple agreement, like once they got the $20, they gave it back to you type deal? But there's a lot more to loan, things of that nature that you guys need to understand. All right. So basically, we started with 3 definitions with it, and they're all located right here: a principal, an interest, and a term. All right. As far as the principal goes, guys, that is the amount of money that is borrowed. Okay. So if I go into a bank, credit union, wherever, and I need to borrow, say, $10,000, that's my principal amount. That is the amount that I have to pay off. Okay. So that is your principal. The second one there, as far as interest goes, we've talked about interest a lot in here, okay? If you're receiving interest, that's a good thing, right? If you are paying interest, not so good, okay? So, but the interest, it's usually annually. I put the percentage sign there, and in parentheses, I put usually annually because it incurs over a yearly time period, okay? And the interest is what's being charged for the right to borrow the money. So that is what the company that you're borrowing the money from is charging you simply to let you borrow it. Okay, like a bank give you 3 or 4% interest, they're going to make 3 or 4% interest off of your loan. Okay, and then the last one there, the term. The term, guys, is the amount of time it takes to pay back the loan and the interest. So if you say you buy something for $3,000 and you have a 48-month term, that's 4 years, right? So your term would be 4 years. And these credit institutions, banks, credit cards, they give you an incentive to try to pay things off. They'll say, well, if you can pay this off in 12 months, we'll make it interest-free. Or if you'll pay this off in 6 months, we'll make it interest-free. If you pay it off early, there's no penalty for doing so. All right? So those are the 3 definitions that I found to be important when it comes to dealing with the credit. And again, guys, I'm going through this fairly quickly because I want to go into something new. This is all can be found online, okay, in your classroom. The next 2 that we're going to deal with here is called secured and unsecured loans. You're going to need to know the difference between those. All right. The biggest thing here with these 2, and I think you guys already answered if you turned in that. Well, wait, did I ask you guys about collateral on that last quiz? I don't think I did. The biggest difference here is the word collateral. I would put a box around it, star it, whatever you need to do. And here's basically how it works. A secured loan, guys, requires collateral, okay? And what collateral is something that can be taken if the loan isn't paid. So, for example, if I borrow $3,000 from a bank, okay, and they want me to put collateral up against it, meaning that if I can't pay that loan back, they would receive something of mine. So I could put my car up against that loan. Does that make sense? If I wanted to get a bigger loan, I could put my house up against that loan. And what that is showing the bank, that is if I'm willing to put my house or my car up against that loan, that I'm probably going to pay that loan back, because if I don't, what does the bank get? My home, right? So obviously I'm going to try to make that payment the best any way possible, right? So a secured loan requires collateral, meaning you have to put something up against it, okay? The second part of that, it says that it is safer for the lender. And what I mean by that is whoever is allowing you to borrow the money, if they require collateral and you give it to them, it is safer for them to let you have that money, because they feel like, well, if they don't pay it back, at least I'm getting something out of it, whatever it is that you put up against it. Does everybody understand that? And then obviously you'll get a lower interest rate. If you got your house put up against the loan, the bank isn't going to make you pay as much interest. Okay? Is that simple enough? Pretty simple, I hope. So that's a secured loan. Just simply remember collateral. That's how it goes with it. All right? The next part of that, is a unsecured loan. And basically, guys, an unsecured loan is the complete opposite of a secured loan. So if a secured loan requires collateral, is an unsecured loan going to require it? No. Okay? So it does not require collateral. It's obviously more risky for the lender. If I let you borrow money and I don't make you put anything up against it, I'm trusting your judgment. I'm thinking you're going to pay me back. Okay? But with that, since you didn't put anything up against it, there will be a higher interest rate that you will pay. There will be a higher interest rate because I've got to make money somehow, right? If I'm allowing you to borrow money. Everybody with me so far? Simple enough? Okay. All right. Next part of this. And I wrote down examples of collateral. You can write that down if you want to, but I mean, I just told you auto, home. You put your farm, if you had a farm up against it. If you had any type of property, you could use that as collateral. There's bunches of things you can use as collateral. You could actually use like an engagement ring or something like that. You know what I'm saying? Anything that has value up to the point of how much you're trying to borrow. Okay? The next part, this one kind of confused the B-Day guys, so I'm going to kind of slow down with this. It says factors that determine the interest rate that will be charged for money borrowed. So basically what I'm trying to get at here, guys, is how is an interest rate determined for each individual? Like, how can this individual have a 2% interest, and why does this individual have a 6% interest? And it all kind of goes back to your credit score and how good you are with money. You guys understand that? So, factors that determine the interest rate. So the first one there, put down credit score. Okay? Guys, the higher your credit score is, the lower the interest rate you will have to pay. So basically, if you buy something and you make payments on time, every time, over a long period of time, your credit score will go high. It'll be high. Roughly, a good credit score is anywhere above 700. It usually cuts off at about 820. Okay? So if you're between 700 and 800, you have really, really good credit. That means you're going to get a credit score or an interest that is low because these companies can trust you to pay that money back because you've never not paid money back. You guys with me there? Now, if your credit score is sorry, say you've had to file bankruptcy or you bought a car and missed 5 payments on it, or your credit score takes a hit every time you miss a payment on something. You guys understand that? So if you have a low credit score, if someone's going to allow you to borrow money, they're going to penalize you with a higher interest rate. Okay? So good score, low. Bad score, high. You guys understand that? It's kind of like golf. I want to, I want to keep my interest as low as possible. Well, in order to do that, my credit score has to be really high. Okay? So the second thing that affects credit scores is the loan amount. Okay? Now, depending on what type of loan you're getting, and what I mean by that is a long-term or short-term loan. Okay? Now, you guys already know some things. If I'm getting a long-term loan, like a 30-year loan, what's the interest going to be on that? High or low? It's going to be fairly low because I'm paying for it for such a long period of time, right? Now, if I go buy something and it's only a couple $1,000s, the company that I'm going to be borrowing money from is going to put a high interest rate on me because they got to make their money somehow, and if I pay that off really quickly, then they're not going to make anything, right? So, the loan itself, if you notice I put in parentheses, if it's a higher principal, and what do I mean by principal? What does the word principal mean? The amount of money that was borrowed, right? So if the principal is high, meaning I borrowed a lot of money, equals long term, that is going to equal, that's actually read wrong, I should say lower interest rates, okay? Higher principal equals longer term equals lower interest rates. All right, now on the flip side of that, if it's a lower principal, it would be shorter term, and what would be the interest of it? Higher. I just wrote that wrong. So this right here, where's my pen? Should be lower. Excuse me. And then the last thing that affects your interest, it says your life situation. And what I mean by that is when you guys apply for credit or you're applying to get a loan or whatever, they're going to look at your background, okay? If you're the type of person that's been employed, say you've been in the workforce for 10 years, okay? And you've had 9 different jobs. That shows a credit company or a credit score company what? That you're not one to stay around very long, are you? You jump from job to job to job to job. Now, take someone who's been at the same job for that same amount of years, for 10 years, they've only had one job. They're more stable, right? So they're more than likely going to pay a loan back before someone who's had 7 or 8 jobs. Okay? And then they're going to take a look at your total debt. If the person that's had 9 or 10 jobs has $100,000 in debt against the person that's had only one job and only has $25,000 in debt, then obviously that is going to affect the type of term and the interest that you receive on that loan. Okay? So that's basically what we went through with B-Day, guys. All right. The last thing that we got through, which is also important, is we talked about what a cosigner is, and then the difference between a variable and a fixed rate loan. Okay. Now again, you don't have to write all this word for word. It's all in the classroom. Okay. This actual video is on the classroom. But I just want to touch base on it so you guys have an understanding before we move on. Okay, so you got at the top there the word cosigner. Okay, now, just to give you an idea, when you guys go apply for a loan, you're going to have to sign a bunch of papers, right? Have you ever been with your parents when they go buy a vehicle or signed off on their home or anything of that nature? They have to sign a ton of paperwork. Okay, a cosigner, guys, is someone who basically must trust you a lot. Okay. Because I'm going to tell you right now, it is not a good idea to ever be a cosigner. Because once I explain to you what it is, it'll make sense. But if you can avoid that, then do it. Okay? Because being a cosigner actually hurts your credit if things don't go the way it's supposed to. So, for example, let's say Seth up here wants to go buy a motorcycle. Okay? And this motorcycle is $5,000. Well, Seth has to borrow the money. Seth doesn't have a job. You know, Seth's 16 years old. He's not got a job, you know, as a constant. You understand what I mean? So he's going to have to borrow this money, but the bank will be like, well, the only way we're going to allow you to borrow money is if you have someone co-sign for you. So Seth calls me. He's like, hey, if you'll co-sign on this loan, I promise you everything will work out. So I trust Seth. Y'all with me? So Seth and I go to the bank. I sign off on this loan with Seth. So I am the cosigner. So here's how this works. If Seth is unable to pay that loan back, guess who it falls on? Me. Y'all with me? And then I am responsible for that loan. Now I can go argue with Seth, try to beat Seth up. Regardless, he don't have to give me a dime. I'm responsible for that loan because I signed off as a cosigner. Y'all with me? I knew the risk. If he couldn't pay it back, I had to. Y'all with me there? So, it's very important. If you ever need to be a cosigner, really think long and hard about it, okay? Because you've got to be able to trust the people that you're signing off with. Y'all got me on that? Okay. So, a cosigner is someone who agrees to take on the responsibility of repayment. And some of the effects of being a cosigner is you have to consider that your credit will be affected negatively if the other cosigner does not pay the loan. So if they're not paying their loan and it falls back on you and you can't pay that loan, that is going to affect your credit score, which will affect how you can borrow money later in life. All right? So obviously, keep that in mind. Best case scenario, don't ever be a cosigner. Y'all with me? Just don't ever do it. But some people do it. Like your parents, they may sign off for something for you one of these days because they'll beat you if you don't get it. You know what I mean? But like family, I would suggest more so with family than a friend because friends, you know, they can throw you under the bus real quick if they need to. Okay? All right. So far, so good. Makes sense? All right. And then there was these next 4 ideas go together. And I don't know if I can get them all in the same picture. I'll try. Maybe I can. Yeah. Okay, so basically, guys, These are the different types of ways or types of credit you can get. Okay, you guys see where I have types of credit written right here? That should actually be up here above this, because all four of these go under the same heading. All right. So the first two, these two ideas, they go together. And what this is talking about is your interest rate and how you want to do it. Okay? The first one says a variable rate. A variable means, guys, and there's a ton of things that go into it. How many of you watched the little video I sent you about the surfer guy? Good. He was talking about how a variable rate deals with like a wave. It's up and down, up and down. Like this month, the rate may be 7%. Next month, it may be 1. The next month may be 3. It's constantly up and down. A variable rate usually is dependent on the stock market. So if stocks are good, the variable rate is good. If stocks are bad, it's usually down. But it says a variable rate is an increase or decrease depending on the federal interest rate environment. So it can fluctuate, meaning it can go up and down. It's not a set in stone rate. Like I said, you may pay a higher interest rate this month. It may be a lower interest rate next month. It may be even lower than next month. But it's a chance you take with a variable, okay? Your monthly payments could be higher or lower depending on the change. One month you may pay $100 in interest. The next month you may pay $10 in interest. We don't really know. All right? Now, on the other end of that spectrum, you have a fixed rate. Most people that like steadiness, stableness, pick a fixed rate. A fixed rate stays the same regardless. Okay, so if I sign a document with a fixed rate of 3% and it's a 30-year term, the first month is going to be 3%. Guess what the very last month of that payment is going to be? 3%. That's how it works. So a fixed rate is an interest that stays the same over the life of the loan. All right? Now, here's a question for you. When do you think it would be a good idea to have like a variable rate? On a short-term or long-term loan?
Short-term.
I would do it on short term. And I especially do it if the economy's doing real well, because it's going to be low. You know what I'm saying? If the housing market's going good, everything's going good, those interest rates are going to be low. So pick a variable, pay it off in 6 months, and you're good to go, right? You may save money. Now, over a longer term, I would suggest picking a fixed rate, because you just can't compute 30 years down the road what the stock market would be doing, or the interest rate at the federal level. Does that make sense? So that's just my opinion. Short-term variable, long-term fixed. Okay. All right. Then at the bottom, and again, all this we went over, but this is probably the first time some of you've seen it, even though it shouldn't be. You got installment and revolving credit. So installments. What is an installment loan? Okay. If you notice, I drew an arrow. It says there are regular payments to pay off principal and interest. An installment, guys, is me making a payment monthly. I make one payment every month for every how long the term is. I'm making installments on it. You guys with me there? It says it's used to finance a specific purchase for a specific amount of time. That is important. You need to know that. See how I've got that underlined? Installments are to finance a specific purchase for a specific amount of time. So I went and bought a car. I financed it for 5 months. That would be an installment loan. You guys understand that? Very specific purpose, very specific amount. Okay? And then a revolving credit is an open line of credit that can be used for any purchase. Now this is a cool deal. Okay? If you've got really good credit, you can go open up a line of credit through a credit union, through a bank, through numerous places, and they're going to say, all right, we can basically let you borrow $100,000 or $50,000 or $25,000 or whatever it is your worth may be, or what your credit score will allow. You with me? So you can use that open line of credit and literally buy anything you want to buy. Okay? But you're still going to be making payments on this thing. These are just not specific ideas. I may want to redo my bathroom in my house. Well, I don't know what all I'm going to need. I know I'm going to need a bathtub, a shower, a sink, all this other stuff, but I don't specifically. I don't know what I'm buying. Right? Tile. I'm going to do tile, hardwood. Open line of credit helps you do that. Okay, so that's a line of credit that you can buy anything with. An installment is very specific. Okay, I bought a house. I have a 30-year term. I have to pay $700 a month for the next 30 years. That's how that goes. That's specific. Revolving credit, I may only owe $100 this month, but I may go make a big purchase next month, and now my payments are higher. You see what I'm getting at? This fluctuates, goes up and down. This one, not so much. All right, stays the same. So that's basically a review of everything that we've got that you guys missed last week. Is that pretty simple? Pretty good there? Okay. So now